Welcome to this IOR England and Wales chapter webinar. I'm Jimmy Hinchliffe, chairman of the chapter, and this is our fifth webinar of this rather strange year. On top of the masterclass we did back in March on operational resilience, and this will be our final webinar event of 2020. And we hope, I think, like most other people, that in 2021 we will be back to more of our normal service, where we can actually have physical events and we can meet with you, our members, and we can get some of those really good conversations going. But in the meantime, until we can do that, we will obviously carry on with these virtual events. Just one quick point on that, on the assumption that we will be back to doing physical events next year. If there are people who are interested in hosting events, then we're always very welcoming of offers to host events at your premises. So please get in touch if you'd like to do that. So to today's event, and I think we have a splendid topic for this final event of the year on the new investment firms capital regime, which seems to have been a topic that's been discussed for almost as long as Brexit. Amazingly, and we have an excellent panel of speakers, and we will use our normal format for today's webinar, as those of you who've joined previous events will be very familiar with. So obviously I'm doing my brief introduction, and then each of the panelists, Brian, Mustafa, and then Tin, will speak for up to 10 minutes, giving us their introductory remarks, and then we will have a discussion and Q&A. And this is where we very much welcome you to submit questions through the chat function, and then I will field them to our speakers. Now, before I ask each of our speakers today to briefly introduce themselves, I will do my usual quick plug for the Institute. So Institute of Operational Risk, founded in 2004, and we remain the only professional institute that is dedicated solely to the discipline of operational risk. And you'll see there our stated mission in terms of promoting the development and discipline of operational risk. So the big year for the Institute last year, in that we joined the much larger IRM group, which has been splendid in terms of giving access to a much bigger group of members. In terms of what you get as a member for your £150 as a professional, so we commit to at least 4 events a year. We have the SPGs, the Sound Practice Guidance Notes, and we've actually done a lot of work this year to update those, and we've issued, I think, already 6 of those that are available to members, and they always prove extremely popular. We provide a networking community, particularly when we have obviously the physical events. We recently started doing a newsletter, which we're going to do on a quarterly basis to keep in touch with our members, and we have a number of other things that you can access through the website. Already mentioned about the SPGs, and they will all actually be updated hopefully by the end of this year. So last year we did 10 events within the England and Wales chapter, and as I say, this year this is our 5th webinar, plus we've done the masterclass. So in the circumstances, I think we've been pretty resilient. Now, in terms of other things, so obviously qualifications is a key part of what we do as well. And we launched in 2018 the Certificate in Operational Risk Management, the CORM. And this is a self-study course, and it's proved extremely popular. And I definitely recommend checking it out. And you can find lots of information on the CORM on the website, on the IRM's website. And just for information, a bit more information. A few more details here on the CORM in terms of the structure and the format and the pricing and what have you. Okay, so on to today's event, New Investment Firms Capital Regime Challenges and Opportunities. So what I'd like to do now is ask each of the speakers to give a brief introduction to themselves before I then ask Brian to kick off with the presentation. So perhaps I could ask Tin first, then Mustafa, and then over to Brian, just to give a very brief introduction, please.
Just making sure you can hear me. Hopefully you can hear me. Sorry about the video, it's being a bit flaky. Yes, I'm an ex-regulator, as it said. I left to TPICAP, where I head up financial and strategic risk, and amongst my sins also heading up our prudential approach in Europe as well. And yes, I've spent time helping out with some of the formulation of the original IFR when we were back at the FCA, and when Brian was also actually back at the FCA. So on that segue, thank you.
Hi, my name is Mustafa Kabus. So I'm the managing director of Monte Carlo Plus. Monte Carlo Plus offers risk analytics, financial modeling, and independent risk and model audit services in banking and finance. We work with very well-known firms in the UK and abroad.
Thanks, Mustafa, and I'm Brian, associate director at Deloitte, where I've been there for about 4 years. I focus primarily on investing firms at the moment, looking at all matters prudential, including wind down and this new topic of the investing firm regime. I'm happy to be here, and as Tin mentioned, we were previously part of the same team at the FCA, where we looked at both the wind down and some of these topics that we'll be covering in the very early days of it, when the firms were lobbying and complaining that it really wasn't fair that they had to be following the FCA, the rules of a bank, when they were investment firms. So if we go to the next slide, you can catch the bottom of it as well. Yeah. So try to cover a few things within the time that we have. If anything, I might just truncate it and pick up some of the points when we come to the Q&A, so that we leave enough time for everybody. But just a quick overview on the objectives for some of you who may not be aware of them. Quick highlights of the rules-based element and the risk-based element, and then at the end, a quick summary of what we are observing as some of the key considerations that are facing firms right now as they begin to consider implementation. So if we move straight into it, and please feel free to shoot questions in the chat as we go along. If we have time, I'll be happy to take them as we go along. Otherwise, we will pick them up in the Q&A after all three of us have spoken. So as mentioned, previously and currently, investment firms have been subject to rules that were really designed for banks. So everyone across Europe agreed that that really was not a fit for purpose position, and everybody agreed that we should be leaving that regime. The question then came, leave and go where, similar to Brexit, and it took a while, and it is taking a while, to agree a new regime that will cover a wide range of business models that are captured within this space. But we got there, and the EBA signed off on the directive and regulation at the end of last year. And that regulation and directive, along with supporting guidelines that they are continuing to put out, will go into effect from 26th of June next year. So that's their implementation date. Unfortunately, we have said goodbye to them, and so we are not obliged to, in the UK, follow the EBA's rules anymore. And the FCA has confirmed recently that even though there'll be a transition period where we will implement in the UK a little bit later, because the UK plans to implement effective January 1st, 2022. UK firms will not be obliged to implement the EBA's IFR IFD. So firms in the UK will continue on their existing regime up and until 1st of January 2022. So you have 6 months, roughly, more time to prepare for those of you who are investment firms. My understanding is that most of you in the audience today, the majority, are investment firms. The box to the bottom just highlights some of the key areas that it covers, everything that you would expect in a prudential regime. So who is captured, what happens with capital and your funds. There's a big issues around consolidation. Liquidity is very important as a key driver of risk and potentially failure for firms. risk management, governance, and the IOR is what we'll be focusing on today in particular. But there are also areas such as ESG, remuneration, and reporting and disclosure that are relevant. But just to give an overview of the two areas that are probably most of most interest to firms, if we go to the next slide. I would say at a high level, what this regime is trying to achieve, it's trying to get to a simpler regime. That's the objective, a simpler regime that is also more risk sensitive than what was there before. And you can take your own view as to whether or not that has been achieved. The way that they've gone about doing this, and this is with very much the influence of the FCA being the regulator, probably the most experienced of supervising investment firms, is that they thought, let's take some factors and indicators that are likely to be used by firms like yourselves in day-to-day management. So they thought, looking at asset managers in their mind, one of the things that they would expect to be readily available would be data on AUM, assets under management. So they used AUM and they proposed AUM as a proxy for operational risk, specifically the risk that you could have mandate breaches or in some way mishandle a mandate that has been given to you to manage. And the thinking there being, the more mandates you have, the more AUM you have, the greater the risk and consequences of harm that could happen if you were to have errors of that nature in that area. And similarly, you have client orders handle, which kind of picks up transaction errors. The more orders you handle, the more transactions, there's a risk that things can go wrong. Client money held and assets safeguarded are obvious in themselves. If you are not diligent in your handling of people's client money or assets, that's an obvious harm. That's the key interest to the regulator. So those four are roughly categorized as risk to client. And the FCA has put in, the FCA, like the EBA, will put in coefficients around that. They're both the same coefficients to measure it. Unless you have the ability to trade on your own account or your full scope firm, those are the only ones you have to consider. If you do trade on your own account, as I think our friend Tim does, then in his firm, then risk to market and risk to firm are additional factors you have to consider. You would also, on the right side, have to consider fixed overhead requirement, which most of you do already. There's a slight difference in that the level of deductions, type of deductions that you're allowed has changed, probably be a little bit more restrictive. So there's a potential that your FOR may increase a little bit compared to what you've been doing in the past. Further guidance on that are to be published. Again, I appreciate that this is a very quick walkthrough, but again, we're happy to take questions on that when we come to the Q&A section. For me, I think this is, a very important area in the regime for everyone, and not just those within the regime, actually. The FCA has published earlier this year finalized guidance on adequate resources, which is applicable to any firm solo regulated by the FCA. Basically, the message there is to say, if you're running a financial institution or entity, you should make sure that there's adequate resources for the level of risk that you're taking relative to your strategy and to your business model. And that's a principle that's applied to everyone who's authorized. It's part of your threshold conditions that you agree to comply with when you are authorized. So that guidance sits under the threshold conditions. And what you're seeing in the new regime is a subset of the message from that guidance paper, which basically says, in not so many words, make sure that you have adequate risk management and that you are managing your risk and that you are adequately resourced. What the new regime is specifically calling out is that they're not too much concerned with processes. They're primarily concerned about outcomes. In line with their objectives, they want firms in their IOR, as opposed to the ICAP, to talk about risk from an outcome perspective. So you will need, for example, to change from saying, I have credit risk or market risk or operational risk, to say, given our strategy, we could cause harm to clients in this way, we could cause harm to ourselves in a certain way, and we could cause harm to the market in another way as well. So that will be a challenge. The second area that I'll flag on the ICARA is that the rules are by default applied at the solo level. So for any of you who are part of a group with several entities sitting underneath that at a court, you are currently facing the challenge of having to do several ICARAs for each entity by default. You don't necessarily have to do a consolidated ICARA at this point. The FCA may decide to ask you to do one, but as currently written, you are expected to do ICARA for every single entity that's covered by this regime. I don't need to say how much of a challenge that might be for some of you, for many of you. Again, the consultation is open for discussion, so there is a potential chance for that proposal to be changed, and we are waiting feedback from the FCA as we speak, hopefully before the end of the year on their discussion paper that was issued earlier on. So let's wait and see if the feedback that has been provided will be taken up. The other main thing to point out on this is that the Pillar 2 assessment that you do will now be legally binding. It won't be guidance, so you won't see the term ICG used anymore. You'll see P2R, Pillar 2 requirement. And where you would have gotten buffers and so on for your Pillar 2B, you might get a Pillar 2G, Pillar 2 guidance covering wind down, stressed coverage of resources and things of that nature. We'll quickly shift to the next slide in the interest of time, and just say, based on what we've been seeing, these are just some of the challenges that firms appear to be facing with implementation. First of all is that there's a different implementation date in the UK versus Europe, as we mentioned before. Secondly, that the regime is not stable as yet. There are lots of guidance elements that are still to be published and finalized, particularly in the UK. So while many of you are really keen to get this done and dusted, some of your work is being hindered by the fact that you still need to wait for consultations to come out and for guidance to be issued. And that will continue to happen this year and into next year. For those of you who have started doing your work already on the K factors, many firms have encountered problems with managing that data and sourcing it, and getting prepared in that area for it. The risk management and governance arrangements may be a challenge for some of you because, for example, as I mentioned, ICARAs need to be signed off at a legal entity level, which means that they need to have governance arrangements at a local level as well. That includes boards and committees and MI. ESG is a topical issue right now for many firms outside of our sector as well. And this regime is no exception. It requires you to identify and assess ESG risk and include that within your ICARA and also report on it. Final point I mentioned before turning over to Tin is an alignment of disclosure, Pillar 3 statements, and financial reports. You will now be required to do both at the same time simultaneously. So again, there's a challenge there for coordination for some firms. That may be a challenge. I will stop there and hand over to Tin to do his piece.
Mustafa next.
Mustafa. Yeah.
Yep.
Thanks, Brian. So I've got some connectivity issues, hence I'm trying to do it without the camera. Now, next slide, please. I already gave introduction to Monte Carlo Plus around service and products for banking finance, around software and model risk and audit and validation. And we've got a number of well-known references and clients. Next, please. Now, here is, I think, a very good starting sort of discussion about the difference in ICARA versus ICAP. And Brian already mentioned ICARA has different starting and ending points, and he also already mentioned outcome-based, i.e. harm to clients and outcome to clients in terms of their benefits, but as well as the risk to them. So ICARA has a different starting point and ending point. It starts with business model and strategy, i.e. firms need to understand what their strategy is, what their business model is. Here is, for example, an example. This is not from the guidance, but this is an example how it could look like. So you've got distribution, investment, operations, support services, for example, around retail, wholesale, and strategic alliances. And this could be that your business. And from there, you've got mandate breaches, system outage, disruption, and so on. Those are the examples of harms mentioned by FCA's final guidance in June this year. Now, of course, there are other outcomes, other risks as well around disruption, around trading algorithms by principal trading firms, and so on. They lead to harm to clients, they lead to harms to markets, and they also may lead to harm to the firm itself. Interestingly, the key point is harm to clients and markets, and harm to firm is less important to FCA. So in that sense, it's secondary. Hence, it is important insofar as it may lead to harm to clients and harm to markets. Hence, it is secondary in terms of its nature. Next slide, please. Now, overall, FCA's expectation on assessment of harm is around so-called what-if scenarios they mention for activities they undertake, as well as activities which are outsourced, and the harms that can be caused from those. FCA specifically mentions likelihood of events and those impacts of events, and even mentions language such as that these events might or might not occur at the same time. So hidden language around sort of the quantitative or more expectations around quantitative assessment of impacts, events, and harm quantification. Now, in terms of course, impact, FCA expects the firms not only to look at the impacts on the firm and the clients and markets as a primary source, but also look at the financial resources available, i.e., don't cause harm, but if you cause harm, have enough resources to cover it, but also make sure these resources are still have enough buffer. They have enough buffer in terms of capturing the risks from these financial resources being even lower than you think. So basically, there's risks around the book value, pension obligation, and so on. And also mentioned by the FCA papers, as well as discussion paper, as well as financial guidance, is around statistical models. For so-called sophisticated firms, FCA expects firms to have some statistical models. And in terms of the FCA checklist, in terms of this in the SREP process, FCA looks at the risk management framework and looks at whether it has a clear risk appetite, whether material risks are adequately identified and quantified, and of course, whether systems and controls are in place, and stress testing still is there in comparison to ICAP, but also specifically mentioned again, like ICAP in the ICARA, the use test, i.e., day-to-day decision-making for decisions around improving controls and so on, and whether firms have enough resources based on their risk profile. Now, next slide will hopefully give you an overview of all these requirements and the sort of qualitative and quantitative aspects of the FCA requirements around the new regime in this way. So basically, you have your pillar 1 at the bottom of this slide, which already Brian touched upon. Those are K factors for AUM, K factor for clients or order handled, and so on. So you can here have up to 8 K factors, and you compare this to your permanent minimum capital requirement and your fixed overhead requirement. So this is your pillar one, formulaic assessment of your capital requirements. But as we already said, it starts with a business model. So basically, the whole ICARA process starts with business model, i.e., you, like as you can see on the left-hand side, you've got forward-looking scenarios reflecting potential harm to clients, markets, and firm, i.e., you have a process of understanding the likelihood and impacts from these material risks. And hopefully, you have then estimated your capital to cover risks for clients, markets, and the firm. And on top of that, you need to look at your additional risks, such as changes in book value, counterparty default risk, pension obligation risk, and illiquidity, a risk from not being able to sell your assets at the fair price. Now, as we can see, there is no mention of like market risk or credit risk as per se as in ICAP, but because it has a different starting point, it doesn't start, the ICARA doesn't start with the risk classifications in banking, i.e. market, credit, operational. It talks very much about potential impacts from various scenarios. Because again, for a lot of investment firms, you don't have enough data. So only thing it's left to you is your subject matter expertise and assessment using some indicators. So these 2 points, basically your forward-looking scenarios and the required capital to cover risks from these scenarios, plus your additional risks, are making your so-called pillar 2R, which already Brian touched upon. So basically, in this case, you look at required capital being the same as your risk appetite or not. If it's not the same, then you go back to your business model. So this is, in that sense, a continuous process. Next page, please. Here, the next slide is one of the key implications as I read it. To me, if you look at these required capital to cover risks to CMF, then if you use severe but plausible hypothetical scenarios to estimate your risks from these clients to markets and the firm, a simple addition of scenarios would imply 100% correlation between events likelihood and impacts. However, in reality, you have a correlation which is not 100%, as well as the likelihoods are not 100%, i.e. a lot of firms we talk to, they look at the scenarios impacts, but less so at scenarios likelihood, for example. These two elements, i.e. the correlation and likelihood not being considered, leads up to 60 to 70% overestimation. So in terms of market risk and credit risk, again, there is potentially a danger of overestimating your pillar 2R if you keep markets too simple, i.e. here in this example for credit risk, if your PD from all your counterparties is, let's say, 3% and your loss given default is 100%, that's where the simple model will give you the same answer. But if your PDs are LGDs, which are, hopefully lower, and they will be often lower, then you again estimate your credit risk, i.e. from counterparty default, the risk associated with those higher than the simple formula. So next slide, please. So those are some of the scenarios and some of the examples of harm mentioned in the FCA paper in June. I have put these across the categories RTC, RTM, RTF. I bucketed them. So those are not, in that sense, coming from the paper, but those to me how, for example, one could bucket them. In fact, you don't have here 3 buckets, but you've got up to 8 buckets here. RTC, RTM, RTC, RTF, RTC, RTM, and RTF together, and so on. You've got up to 8 buckets here. In terms of time, I'm moving to next. Please, next slide. Here's a template to quantitatively to capture your harm and potential impact from a scenario. FCA already mentioned it doesn't look just only on compensation and only direct costs, but also indirect costs such as fines, litigation, and even payments to protect franchise value. And on the left-hand side, I have up to 6 categories which a lot of our clients use, which I thought I want to share with the audience here. Next slide, please. Is in terms of, again, likelihood for a scenario for these so-called what-if scenarios, a lot of firms find it very difficult to assess likelihoods, to give a percentage, but it doesn't have to be a clear and a very sort of precise number. You could start with assessment by your subject matter experts around assessments such as very remote, unlikely, and so on, and you could assign a percentage for those. So it could be as simple as this. And as a lot of firms will have done some of this analysis, they will see the likelihood is less important than the quantification of impact in terms of its sensitivity. Yeah, so basically I move on to Tins, please, and I thank you to the audience.
Thanks, Brian and Mustafa. My slides are very simple. It's sort of 7 bullet points, really, and they're no particular order of importance necessarily. I've tried to put the more interesting things towards the top, and my interest dwindled down the page slightly. I think picking up from what Brian and Mustafa have said, I think the 2 things to point out, there's quite a lot of mention of consumer, and that's not always applicable to your business models, depending on which legal entity that you're in. And I don't think the FCA are overly inclined to define what consumer is, but I think that's an easy definition for people to work out. So, you know, non-professional, non-sophisticated, wholesale, all the wonderful taxonomy of words and people and legal entities you can describe as professional. I think that there's a bigger challenge in the sense there's no legal definition of harm. The lawyer in me squirms a little when people say, oh, yes, we've got to work out the harm to people. It's like, well, what does that exactly mean? So that's again an unanswered question. So the positives, I think, to the investment firm review, apart from a couple of definitional things, including clarity around the Pillar 2, which has been forthcoming for a while, but never been quite delivered. It's more business model focused, so I think that's a positive. It is simpler. Certainly, the Pillar 1 is very simple. Hard to tell what the Pillar 2 is shaped like, but Mustafa's given us a good idea of what it could look like, I think, certainly. On the less positive, you know, is the simplicity going to sacrifice risk sensitivity for more complex, larger firms? That could be a challenge, but they've already included an out in terms of larger firms within the solo regulated space could still be prudentially regulated under CRD. So that's an interesting, but they haven't said which firms, as always. So that's going to be interesting to see who fits under which bucket. And I think that the psychological challenge, being an old-fashioned Basel kind of guy, is going from the sort of 3 risk approach into a K-factor approach. On a linear algebra basis, I want to know what the translation matrix looks like for consistency purposes, but there is no path that's being defined going from that traditional 3-pillar risk approach to a K-factor approach. So to me, it's kind of like turning it sideways rather than having columns and layer. You now have layers, but the layers are, depending on which K-factor, of different thicknesses of ops risk, credit, and market risk in great regard. So there's no straightforward parallel between how to translate from a vertical and horizontal-ish kind of view that I feel that Basel to investment firm review takes. Actually, going now back to the slide, again, practicality. We've had a pandemic. You know, has there enough time for people under this regime to get data? That's always interesting. And also the timeline of the investment firm review hasn't quite reflected things like Brexit and the pandemic delaying things. So there is some wiggle room, but I don't know how much that there is within the UK. I think Europe is still trying to continue ahead at the same speed, but it's been tricky. I've mentioned the classification point. If you're a super large firm and you're clearly a credit institution, I think that's very straightforward. If you're a very small firm, that's also very straightforward. But if you're somewhere in the middle, certainly towards the top end of what Brian and I used to know, if you're a P1 firm, there are some question marks, I feel. There's also remuneration being tied in, as well as ESG. I've already mentioned Brexit and two possibly different regimes, and that's a more political question. But remuneration and ESG are starting to get folded into prudential regimes, and it's interesting to see how that all dovetails. But just a reminder to people, the regulator under the investment firm review will have abilities to restrict variable remuneration if inadequate financial resources are considered to be present in a firm or a legal entity. As Brian mentioned, one for each legal entity, that's pretty challenging. How's group consolidation, group waivers? That's not quite entirely clear, certainly in my reading. Hopefully people, smarter people than I can figure that out pretty rapidly. Concentration risks, arbitrary 25 versus 25% levels. There's a lot of what I call static numbers within the investment firm review, which rolls onto my next point. It's how are these numbers generated, and depending on your macroeconomic cycle, whether you're in a forthcoming recession or a growth period, how are these numbers calibrated? Are they calibrated for worst case, best case, and are they going to be recalibrated if we have one of the worst crises since World War II, which it looks like we possibly could have? So these are some of the more philosophical and sort of practical, hopefully, questions that and points that I've put into your head to go back and consider how the regime applies to you. So I think that's pretty much it from me. It's just a few sort of passing thoughts, really.
That's great. Thanks to you all for those really interesting presentations. Not too many questions coming through, so please send your questions and I will ask those to the panel. But in the meantime, we have a few questions that we prepared earlier, and I think I would like to field the first one, if I may, to Brian. And this is, I think, a really important question, just in terms of the practical challenges of moving and implementing the new regime, which is the extent to which firms will be able to leverage their existing ICAP approach and processes. I think you're on mute, Brian.
Thanks. If you want to, you can flip on to my slide 5 if you want to, while we're speaking to this. The ICAR is definitely a different beast to the ICAP, but what I would say is if you have a robust risk management framework already that includes clear articulation of your risk appetite, so a clear risk appetite framework, and if you have good within that, for example, good risk identification, then the shift to the ICAR should not be a big challenge for you. Many firms currently within the FCA's regime already have to answer questions on how they deal with conduct. So the FCA has been saying for a long time to identify potential sources of conduct risk, as they call it, and how they're managed. And they've been encouraging firms for a long time to have MI around that. So ideally, in most mature firms, you would have been having processes to identify potential conduct risk or harm in that perspective. And all that this regime is doing now is bringing together conduct and prudential and asking you to consider that when you're assessing your resources. So to the extent that you have some of these things in place and you've already been answering questions around conduct, it won't be a problem. For those who do not have as a robust framework and have not really been doing a broad range of risk identification, so the metrics that Mustafa mentioned around the different types of impacts, then it will need some work to review and refresh your risk management framework, your documentation, your processes and policies, and to then begin to think about how to assess risk to harm, risk to market, risk to firm, risk to client, risk to market, and risk to firm. And there's several ways of going about doing that, which I think might be one of the other questions we could come on to. So I think the answer to Jimmy's question in short is it depends on where you're starting from.
Tim, do you have any thoughts on that, given that you come from a very large organization?
I'm less optimistic, but I've always been a renowned pessimist. I think Brian knows me far too well. I think, you know, psychologically, it's very hard to get a market risk person to think about operational risk, and, you know, heavens forbid to introduce an expected shortfall calculation to an ops risk person. So you know, down the top end, I think it's going to be challenging. I think, you know, getting the K factors at pillar 1 level is probably quite straightforward. That's a question of data gathering and a little bit of tweaking, hopefully, to current data gathering systems that exist. And that was the entire, I think, thought process and philosophy behind the FCA's more and the EBA's more simplistic approach that they wanted to introduce in the investment firm review. I'd still like the dark arts of, you know, it's stochastic calculus, so I prefer the complicated stuff, as does what staff do. So you know, I think the pillar 1 that they've disclosed already, I think, is nothing scary. I think that's a good, very warm, fuzzy feeling. I think, you know, the fact that it's also floored at your previous SHREP level, or your, you know, or the higher of basically, you know, your current pillar 1 K factor calculation, also makes it slightly tricky for someone like myself to go to a board, for example, and saying, you know, we've got this new regime, there's a benefit for us for doing it, apart from being good corporate citizens, let's go do it, versus, well, we've got zero commercial benefit that I can see. I can't even figure out what the pillar 2 looks like, but everyone says it's going to be about the same. We kind of have to do it, but, you know, it doesn't give me any levers to pull to put it at the top of that priority tree when it comes to that risk management approach.
Yeah,
Thank you.
I agree.
Yep.
I agree. I mean, a lot of firms we have in the past dealt with, ICAP was never the most important thing for them to do. It was something they had to do by the end of the year, just rush it, get it done. But ICARA hopefully will change the way firms look at it and take risk management seriously. Basically, understand your business model, link risks to risk appetite, and that again works with understanding risks and impact to the firm as well as the clients and the market, and then linking to risk appetite basically, and establish a quantitative assessment of what is your risk appetite really. I mean, one way of doing it is, for example, to say, are you a triple-B company, or do you want to be a, you know, double-A company? If you are a triple-B company, your risk assessment should be at 99.5 confidence level. This is very simple. So, and if you're you know, double-A company, then it's going to be 99.97 percentile. So basically, like even that level. So you have to start somewhere, and the ICAP, taking ICAP and copying and pasting and changing the titles won't work. Basically, you have to, I think, to me, rewrite ICARA. So you have to start from fresh, and that's an opportunity. Understand what you are doing, what's your business model, understand the strategy, what you are trying to achieve, and also not only 1 year, but also 3 to 5 years, and link it to your risk appetite in, of course, not capital, but also liquidity side.
Okay.
I mean, I agree with you, Mustafa, and that is the ideal approach. What we are seeing is that I think there are 2 approaches. One is, as intended by the FCA, you take a blank sheet of paper, you articulate. For some firms, they have never really articulated their strategy properly before, and they've never really articulated their risk appetite. So one approach definitely is to start from scratch, get all this stuff on paper, analyze the risks from your strategy, and build it through to decide what the impacts might be by the different 3 buckets, or in your case, you're saying 8 buckets: risk of harm to clients, markets, and the firm. The other approach, however, is that I'm seeing a lot of firms considering is simply taking the outputs that they have currently, say for operational risk, by causal category, and then trying to do a mapping through to outcomes in the 3 buckets. I think many firms are hoping to use that approach to kind of shortcut to get to an answer on risk to firm, market, and and clients. And again, I'm happy to take views from the audience as to whether or not you think that approach is viable. We'll wait to see if the FCA is pushing one way or the other. But you know, those are the two basic ways I'm seeing from thinking about it right now.
So we had a couple of questions, but they're questions around whether the slides will be available. And I can confirm that the slides will be available on the website after this session, as well as recording. So for someone who was at the FSA when we were working on the Basel II, and one of the the primary concepts of Basel II was around the use test. It's quite striking that that is mentioned again here. Using ICAR in day-to-day decision making. The use test seemed to me rather unfashionable, sort of post the global financial crisis. How significant do you think it is that there's an emphasis again on the use test, and how do you think that will play out? Maybe Tin, if you have any thoughts on that, be interesting.
I haven't seen many firms use their ICAPs or ICARAs in full in their decision making. What I have seen is they've used parts of it. The key parts being the sort of stress testing and the capital allocation parts mainly. They've used the results of the ICAP in the review, and they've gone, well, that's a bit of a riskier legal entity, and they've not made as much money on a risk unit basis, economic capital or whatever risk unit they want to, and then they've gone, well, we want to underweight that and we want to overweight a more profitable in terms of on a risk basis. So there is that. I think that there's a long way to go to what I call a sort of utopian state of risk management, where everything is based on a very quantitative level and decisions are made that way. I think this is a reasonable stepping stone. What I fear is, firms basically, as Brian alluded to, having a go, going, well, we've always done our risk processes and management this way. We've got the outputs. How can we map, which is hence my linear algebra reference, how do we translate this matrix into the one that fits into the one the regulator's expecting to see? And if I'm a P2 firm, I hope they'll never read my ICARA properly and they never visit. Whereas the P1 firm, they kind of sort of, our larger firms tend to have rather more intimate relationships with their regulator, which is for better or worse, really.
Brian, Mustafa, any thoughts on that?
Well, I just briefly. Brian, please go ahead.
Go ahead. Yeah, go ahead.
So basically, all the firms so far I've worked with, only a small portion of them had a proper risk-based decision-making, or i.e. use test implemented. Even some so-called sophisticated banks haven't sort of managed to put this in use, such as so-called risk-adjusted decision-making, such like a RAROC. The concept of RAROC, risk-adjusted return on capital, is there and has been there for at least 20 years, but I haven't seen any well-known institutions which do it properly, even in trading sides. So basically, a lot of times this assessment of market and credit is there, but when it comes to operational risk, it hasn't been done properly and it hasn't been put in use. So basically, these what if scenarios, for example, and taking those and understanding those in terms of implications for a product, and like a retail product, what it means launching a new product, and i.e. what are the key risks that could emanate from those to the clients or to the firm, hasn't been properly assessed. And yes, in so-called risk controls assessments, yes, but never quantitatively. So all very qualitative and very wishy-washy.
Yeah, I mean, I agree that it's not been seen very often, but and if you want to switch to slide 3 of Mustafa's slide, I think that might help the discussion. I think the intention of the regime is to drive and that kind of embedding of risk management. I think, yeah, that slide 3 before, one down, one up, yeah, that one. And the reason I'm saying that is because you will find yourself repeating exercises and processes several times if all you try to do is tick the box, honestly, rather than actually take the bit and go for it. So for example, if you don't crack the risk appetite framework properly and continue to rely on very loosely defined, unquantifiable, unmeasurable risk appetite statements that nobody really follows, it will impact the quality of your risk selection. Going into the pillar 2 element of the ICARA, it would impact your stress testing, your reverse stress testing, your wind down planning, and liquidity, which are all elements now brought together in it. So to answer the question, at what point will you need to wind down for your wind down planning, you need to refer to your risk appetite statement framework. To answer the question, at what point will be non-viable for reverse stress testing, which is also required in the ICARA, you won't be able to do that. To talk even about ESG risk and say, how much risk are you willing to take, and therefore, what's the potential impact on ESG from a capital and liquidity perspective, you need to have some sort of reference. And stress testing is an obvious one, where it's been said many times with the new regime, what does severe means? Severe in the first instance will be judged based on your firm's risk appetite statement. So if you have the capacity to take a certain amount of risk, then severity can be seen in that light. So if you define your appetite really well, you can explain pretty clearly to the regulator why you think your approach to stress testing is severe. However, if you choose not to have a robust risk appetite framework, then it's very difficult to defend that your stress testing is severe, and you leave yourself more open to regulatory challenge. Not that it won't come anyhow, but you leave yourself more open to that. So if you were to start doing that, then a question of risk appetite, I think when you get to a query, should we launch this product? Should we go into this new jurisdiction? Should we expand or reduce the scale of our firm? Those are all risk appetite questions. And eventually, I think there is a way of making it add value in all the different things that you're thinking about in normal business. But let me see if I'll stop and see if maybe Tim disagrees or agrees from a practical perspective.
I think, you know, trying to convince business owners and front office people and CEOs and such like of cost effectiveness, unless you have a rather large section 166 whacked over your head, tends to be quite tricky, I think, which is why I say people have tended to selectively use parts of ICAPs and ICARAs, and even then it's very hard because if front office owners don't like your Monte Carlo simulation, they'll just ask you to keep re-rolling the dice and the big bucket of dice to get the result that they want. So there's a bit of, you know, if we're all, you know, sort of math functions or robots or entirely purely logical beings, I think things like ROC and such like would have taken hold years ago when it was first conceived. I think there's a lot of human elements in it. You know, ESG, there's the governance and the social side, which is, yeah, I would argue inherently is very difficult to quantify, no matter what behavioral scientists want to say to me. You know, it's very hard to judge, you know, what's going on in people's heads. You can only sort of do a post-mortem on what people have actually done by their actions and evidence. So I think there's a fine line to be struck as to, you know, making sure that your ICAP and your ICARA do what's intended by the regulation and doing that in a cost-efficient way, versus minimizing the traditional approach, which is minimizing the capital implication of that ICARA and ICAP, and obviously any liquidity implications via your ILAP and ILA and the equivalent in the ICARA. There's those sorts of optimization factors, but then the added value is where you have to draw out is, can you help improve the processes that exist within your firm on a practical level? So one example I would share with people is the concept of a Chinese wall. So we had a Chinese wall policy. There's no aspirations as why I'm talking about Chinese wall being looking like Chinese, but it wasn't being governed and implemented properly, and actually repairing fences and building appropriate barriers and following good governance, which is what all of this eventually leads to, and giving information to that good governance and making the right decisions, that actually probably helped spur on about £4 million of extra revenue. And that is then a very easy sell, because I can have that conversation with the CEO of that division now, and he'll listen every time. But you've got to deliver that level of value, because that was about I don't know, 30% of his profits for the year or whatever it is, at this time. I can't remember, some number like that. And then once you get your head out of the tick boxing, meeting the regulation, and then actually lift your head up and look at the practical implementation of, okay, what does my review, what does my risk framework tell me, and what do I do about it, rather than just going, well, it's like, saying to a driver, your warning light's on, but without telling them what it means, what you need to do, how do you fix it, how do you optimize it, what's the best place to take it to fix it. There's a load of what I call follow through that I think a lot of firms don't do, because people are so focused on the delivery part, which is not incorrect for most risk managers to focus on, because without the delivery of your dashboards and your MI and whatever, you don't have any evidence of which to go back to, board meetings and risk committees to say, well, let's do this, or let's invest a couple of million here, or whatever it is. So I think you've got to start at square one, which is you've got to build an effective enterprise risk management framework or risk management framework, but not over-engineer it, and actually get something that works first, then look at how to deliver best value, and don't having helped build one for TPI Cap, don't overly obsessed, and this isn't sounding like me, and Brian knows that I love to over-engineer most things. Don't over-engineer it. Just get something that gets you off the ground first, and have a look at the lay of the land, and then where to focus your efforts on practical things. And to quote Obama, the world is a horrible, difficult, messy place. I'm paraphrasing very badly what he said, and there are no elegant solutions. So I think that's all worth bearing in mind of taking something that's very wonderful on paper, supposedly from the regulated EBA, the FCA, and all the rest of them, and actually what does it actually practically mean? And as I would think as a hopefully decent risk manager myself, that's the bit where you can add value, is how do I get use of this and make use of this within my own organization properly to make it effective, rather than just going, it's a regulatory hurdle to pass, because I'm sure any decent risk manager can hopefully cobble together a decent ICAP in their suite.
Brilliant. All right, thank you very much. And conscious of time, we're almost up, but I would like to ask you a question that has come in from the audience, which I think is a very good question. And the question is, because the ICARA is needed on a solo basis, are we expected to break out group risk appetites to a solo level? Very good question. Who would like to have a go at answering that?
I'm happy to start. There are lots of unintended consequences to putting a requirement to do prudential regulation at a solo level. And I think you've just put your finger on one of them. If you think about it, at any entity, you should, in theory, and this is the theory, I'm not saying I agree with it, in theory, an entity that's a legal entity and authorized in its own right with its own board should have its own MI and its own risk management arrangements. Now, those things may be shared. You may have the same framework, but if you are signing off, if your board is signing off on ICARA, it must be managing the risks that are talked about in the ICARA to get to there in the first place. So yes, unfortunately, just by simply saying you must sign off the ICARA at a legal entity level, it implies you have to have all of the framework behind that to support the board putting their signature to the ICARA. Otherwise, this is simply a tick box, and if questioned, challenged, examined, it really won't hold up. Now, of course, I mean, there's a possibility of sharing frameworks, but and maybe sharing personnel or whatever, but at some level, there needs to be an evidence that you considered what were the risks for your firm, your entity, and that there's some sort of paper trail as a very minimum, at least I would think.
I'm going to cite one of my 7 bullet points, Jimmy, and say it all depends on how the group consolidation works eventually, and it's not immensely clear. If you're a credit institution with a solo regulated entity, you'll probably find it highly unfair, and this is a conversation perhaps you should have with your FCA regulator if you have one, supervisor, if you have one, is that you then run effectively 2 prudential regimes. I don't think that was their intention, but they haven't said that in a black and white CP or publication anywhere at this time.
Great. Okay, I think we're now over time, so I would like to thank you all, Brian, Tin, and Mustafa, for a really interesting session, and thanks very much for the audience. Just to say that we've already started working on our program of events for 2021. We'll be starting off in the first quarter with an event titled "The Rise of Operational Risk," to reflect the popularity of, in particular, operational resilience. But also obviously the impact of COVID. So we will look forward to seeing you there. And in the meantime, we wish you a Merry Christmas and see you in the new year. Thank you.